On November 2nd, 2022, a reporter at CoinDesk obtained a private balance sheet for Alameda Research, the trading firm controlled by Sam Bankman-Fried. The document listed $14.6 billion in assets. The single largest line item was $3.66 billion, labeled Unlocked FTT. A second line read FTT Collateral, $2.16 billion. FTT was not an independent asset. It was a token issued by FTX, the exchange that Bankman-Fried also controlled. Alameda's largest disclosed asset was a claim on a coin that its sister company had created. What the balance sheet did not show was a liability. By the middle of 2022, according to the CFTC complaint filed December 13, 2022, Alameda's total fiat liabilities with FTX were close to $8 billion. That liability did not appear on the document. It sat inside an account that employees, using language that appeared in internal communications, called the Weird Korean account. That account belonged to Alameda. It was not labeled as such in FTX's ledger. This episode is about what that account was, why it existed, how it was structured to stay invisible, and what the bankruptcy filings found after FTX collapsed 11 days after CoinDesk published that balance sheet. The account's internal label in FTX's database was FTX Fiat Old. Its identifier in the exchange's system was fiat at ftx.com. It had been created in the early days of FTX to process customer fiat currency deposits, dollars wired to the exchange, while FTX was working through banking difficulties with Korean payment providers. In practice, the funds that moved through this account were held in Alameda's custody. Alameda controlled the account, but because the account was not tagged with an Alameda identifier, it did not appear in any internal report that aggregated Alameda's exposure to the exchange. When FTX's own engineers later discovered it, they used the same language Bankman-Fried had used with executives, according to reporting by the Wall Street Journal, corroborated by subsequent court filings. The CFTC complaint records that Bankman-Fried himself referred to it as the Weird Korean account in communications with FTX leadership. The CFTC complaint states that Sam Bankman-Fried directed business leaders to transfer money to what he referred to as our Korean friends account. By the middle of 2022, the negative balance on that account alone represented close to $8 billion in customer deposits that had moved from FTX to Alameda. The account did not appear on Alameda's balance sheet. It did not appear in the financial statements customers relied upon. It did not appear in any document that would have shown Alameda's true exposure to FTX. It required a specific piece of code to function, a code change ordered in 2019, 3 years before the exchange collapsed. Gary Wang, co-founder of FTX, testified at trial in October 2023 that in 2019, Sam Bankman-Fried ordered him and Nishad Singh, FTX's director of engineering, to add a feature to FTX's code. The feature added a database column called allow_negative. Wang testified the change went live on July 31, 2019. What the allow_negative flag did, Wang explained, was give specific accounts the ability to withdraw funds they did not have. It exempted flagged accounts from the overdraft checks that governed every other account on the platform. A later commit by Wang also exempted those accounts from the auto-liquidation procedures that would otherwise have triggered when an account went deeply negative. In Wang's words, if an account held $10 but wanted to withdraw $100, the flag allowed the firm to do that and to carry the negative balance indefinitely. 2 accounts held this flag from the beginning: Alameda's primary account and the account internally labeled FTX Fiat Old. Alameda's accounts could borrow from FTX without limit, without collateral requirement, and without the automatic liquidation mechanism that every other user on the platform was subject to. Wang pleaded guilty to fraud charges in January 2023. He testified against Bankman-Fried as a prosecution witness. The balance sheet that CoinDesk obtained was a private document shared with Alameda's lenders. It was not a regulatory filing. Alameda had no public disclosure obligations, but it had represented its financial position to outside creditors, and this document was what those creditors had seen. The asset side totaled $14.6 billion, of which $5.82 billion was in FTT, either unlocked or posted as collateral. The document listed $134 million in cash and equivalents against total assets that were overwhelmingly denominated in illiquid or exchange-linked instruments. What the document did not reflect was the liability the allow_negative flag had enabled. By mid-2022, Alameda's accounts on FTX carried a negative balance approaching $8 billion. According to SEC complaint Case 1:22-CV-10501, filed December 13, 2022, Bankman-Fried directed Caroline Ellison, then CEO of Alameda, to conceal this line of credit from Alameda's lenders. He was concerned, the complaint states, that the liability would alarm them. The balance sheet that lenders received did not include an $8 billion liability. That liability flowed through an account in FTX's database, the account labeled FTX Fiat Old. The account held the negative balance. The balance sheet held neither. The crypto market contraction that began in May 2022 placed direct pressure on Alameda's trading positions. When the Terra/Luna ecosystem collapsed, Alameda held significant exposure. Its positions moved against it. Under the terms that governed every other FTX user, those positions would have been liquidated automatically. The allow_negative flag meant they were not. Instead, Alameda continued to draw on its FTX credit line to cover margin calls, extend emergency loans to distressed counterparties, including Voyager Digital and BlockFi, and fund ongoing operations. The $5 billion it had used for venture investments and political contributions, according to the April 2023 debtors report, had already been deployed. In late June or early July 2022, a senior FTX software developer named Adam Yedidia went to Bankman-Fried directly. Yedidia had just corrected a bug in FTX's accounting software, a bug that had overstated Alameda's liability at $16 billion. The corrected figure was $8 billion. Yedidia found Bankman-Fried on a paddle tennis court at their shared residence at the Albany complex in the Bahamas. He asked, "Are things okay?" Bankman-Fried's response, according to Yedidia's trial testimony, was, "We were bulletproof last year. We're not bulletproof this year." Yedidia testified that he interpreted that as acknowledgement. He did not learn, until the bankruptcy, that Alameda had been using FTX customer deposits to pay its creditors. On February 9, 2022, Bankman-Fried submitted written testimony to the United States Senate Committee on Agriculture, Nutrition, and Forestry regarding digital asset regulation. The testimony presented FTX as an exchange committed to transparency, compliance, and customer protection. It called for clear regulatory frameworks and offered FTX's cooperation with federal oversight. By that date, the allow_negative flag had been live in FTX's codebase for more than 2 years. Alameda's primary account and the FTX Fiat Old account were already exempt from the platform's overdraft and liquidation rules. On November 7, 2022, one day before FTX halted customer withdrawals, Bankman-Fried posted publicly, "FTX is fine. Assets are fine." The previous day, according to testimony, he had written in a private document that FTX had enough liquid assets to process approximately 1/3 of remaining client withdrawal requests. In March 2022, 2 separate accounting firms issued clean audit opinions on FTX entities. Armanino LLP signs the financial statements for FTX US, the American regulated subsidiary. Prager Metis LLP signs the opinion for FTX Trading Limited, the offshore entity headquartered in the Bahamas. Neither firm audited the FTX group on a consolidated basis. No consolidated audit existed. The offshore entity, FTX Trading Limited, audited by Prager Metis, was the entity through which the Alameda credit line operated. The FTX Fiat Old account sat within FTX Trading Limited's structure. The Prager Metis opinion covered FTX Trading Limited as a standalone entity. It covered what was disclosed to the auditor. The $8 billion liability flowing through the untagged Korean account was not a line item in any document the auditors received. Armanino resigned from the FTX engagement in December 2022, 1 month after the bankruptcy filing. Prager Metis faced separate scrutiny after the collapse over the scope and methodology of its work. On November 2, 2022, CoinDesk published the Alameda balance sheet. 4 days later, Binance CEO Changpeng Zhao announced on Twitter that Binance would sell its FTT holdings, approximately $580 million worth, received as consideration from an earlier FTX equity transaction. His stated reason, due to recent revelations. FTT's price fell. As it fell, the collateral backing Alameda's lender relationships declined in value. FTX customers began withdrawing deposits on November 6th. Within 72 hours, withdrawal requests reached approximately $6 billion. FTX's liquid assets were insufficient to meet them. On November 8th, FTX halted withdrawals. On November 10th, Bankman-Fried tweeted that FTX had enough to cover all client holdings. On November 11th, FTX, Alameda Research, and more than 100 affiliated entities filed for Chapter 11 bankruptcy protection in the United States Bankruptcy Court for the District of Delaware. Bankman-Fried resigned as CEO. 6 days after the bankruptcy filing, John J. Ray III submitted his declaration to the Delaware court. Ray had overseen the Enron liquidation. He had spent decades in corporate restructuring. Paragraph 5 of his November 17, 2022 declaration reads, "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here." The declaration documented what Ray's team found. No board of directors functioning in any meaningful capacity. No accounting department, no consolidated financial statements for the group, no cash management system capable of identifying which entity held which funds. Payment approvals had been issued via emoji in a messaging application. Ray stated that the debtors had located and secured only a fraction of the digital assets they expected to recover. In March 2023, the bankruptcy estate filed schedules of assets and liabilities for the debtor entities. The schedules placed the total shortfall in FTX customer accounts at $8.7 billion. Of that, approximately $6.4 billion had been in fiat currency and stablecoins. Customer deposits transferred from the exchange to Alameda in cash equivalent form and then deployed. The group-level balance sheet, reconstructed by the estate from fragmented systems, showed a deficit of $6.8 billion at the time of filing, with a deficit of $10.6 billion in the FTX.com enterprise alone. None of these figures had existed in any document presented to investors, lenders, customers, or regulators before November 11, 2022. They were produced for the first time in bankruptcy court, assembled from records that required months of reconstruction. Sam Bankman-Fried was convicted on all 7 counts of fraud and conspiracy on November 2, 2023, exactly 1 year after CoinDesk published the balance sheet. He was sentenced to 25 years in federal prison on March 28, 2024. The Alameda balance sheet that appeared in CoinDesk on November 2, 2022 was missing a single line: the $8 billion that Alameda owed FTX. That liability had been routed through an account with no Alameda identifier, enabled by code written in 2019 at the specific instruction of the exchange's founder, and left outside the scope of both audit opinions the group had commissioned. The public version of FTX was a regulated platform with audited subsidiaries, published terms of service, and a CEO who testified before the US Senate about the importance of customer protection. The account, labeled FTX Fiat Old, was the distance between that version and the one that reached bankruptcy court. The mechanism at FTX required code, an untagged database entry, and 2 clean audit opinions, each covering a different piece of a group that was never examined as a whole. The next case required only one thing: a machine that didn't work and a set of laboratory reports that said it did. Next on hidden liabilities. In 2014, Theranos filed a Form D with the SEC, valuing the company at $9 billion. That same year, the company had quietly shifted the majority of its patient tests to third-party analyzers. The laboratory documents from the period show what the Theranos device was actually producing. The CMS inspection report, issued in 2015, described conditions that posed immediate jeopardy to patient health and safety. Elizabeth Holmes had read it. This is the story of what was in those documents and when the people who signed the investor agreements had seen them. Subscribe and you'll be there when it drops.